What's up, guys? I'm Nobody Special. With this news coming out of South Africa over the last few days and the ensuing market sell-off, I've seen a lot of folks, including a lot of channels that I follow and respect, have been talking about how this is it. This is the big one. This is the big sell-off. The era of fiat money is over. The stock market is over. The easy money is finally coming home to roost. Fire and brimstone, dogs and cats living together. Mass hysteria. Well, I disagree. I don't think this is the big one. And we're going to get into why, but the answer lies in the bond market, and we're not quite there yet. Are you ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special. And with this sell-off based on the news coming out of South Africa recently, I've seen a lot of the channels that I like to follow have been saying that this is it. This is the big one. The fiat money scheme is at an end, and this is the big monster sell-off that we've all been talking about for years. Respectfully, I just don't see it yet. The answer to that lies in the bond market and the availability of easy money. And really, that's what this economy is based on. We're a debt-based economy that is dependent on easy money, and we still have that easy money. So I don't think this is the sell-off just yet because the Fed has not yet taken away the punch bowl. They will very soon. Now, before we get into the specifics, I have to ask, could you please like this video, subscribe to my channel, and hit that notification bell? It would really help me out. It helps me to keep this channel growing, and I'd be forever in your debt. Now, with that, it is time to shrink my big, fat melon of a head. And let's get into why I don't think this is the big sell-off just yet, even though we've seen a lot of volatility. First of all, we're a debt-based economy, right? So a debt-based economy is dependent on easy money or having a lot of access to money, liquidity, right? And this, looking at the reverse repo situation, there is still a mountain of money just sitting out there in the banking system with nothing to do. And we don't get the big sell-off, in my opinion, until we see that liquidity dry up. Now, I have to preface, I'm not a financial advisor. This isn't financial advice. Do your own research, your own DD, arrive at a decision that's right for you based on your unique situation. But when I look at this chart and I see this mountain, I mean, we are looking at $1.4 trillion a day in excess liquidity is just being parked at the Fed overnight. That tells me we are not about to run out of money anytime soon. Now, if you'll notice, this chart has gone straight up this year as the Fed has continuously pumped money into the system, especially since March when they ended the exemption to the supplementary leverage ratio, which was a rule about how much treasuries and collateral the banks had to keep on their books to offset our deposits. All right, and that's really where the reverse repo situation was born, as the banks had to park that money somewhere in exchange for borrowing treasuries. So that's what's driven this big trend. We've had a shortage of treasuries because of the debt ceiling, because the government hasn't issued a lot of treasuries this year. And we've had all of this excess cash that the Fed has printed, and that has created this imbalance in the banking system. Well, you'll notice this chart has leveled off, and it's gone flat. Really, since the beginning of October, which was when the debt ceiling was suspended again. Remember, they did that temporary suspension of the debt ceiling from October to December. The reverse repos have not really grown since that day. And actually, they've leveled off, and we're even starting to see them tick down. Now, we are right up against that debt ceiling again right now. So there's a couple of things when it comes to the debt ceiling. First of all, politically, okay? It's Christmas, and we're heading into an election year. So I want you to tune out all of the political jawboning that's going to go on over the next few days. And it will get ridiculous, folks. It will get ridiculous. But I'm going to go out on a limb and say that nobody is going to destroy the economy right before Christmas heading into an election year. Nobody wants to do that, okay? Nobody wants the government to shut down. Nobody wants to default at this time of year with an election next year. So I think once all of this political jawboning is done, the debt ceiling gets raised anyway. Now, how much? I think they're going to extend it beyond next year, all right? Because they're not going to have another one of these debates while they're all campaigning. They don't want to do that. That's the one thing they both agree on both sides of the aisle, is they want this issue out of the way going into the election year. So when they suspend the debt ceiling or raise it again, they're going to give themselves enough margin to get beyond the election. So it's going to be a big race. Now, right now, I think the market is starting to price in a little bit of panic around the debt ceiling and around the government shutdown, but I think that is misplaced because I don't think that happens. Okay, now that we've addressed that there is ample liquidity in the market and that I think there's a little bit of panic being priced into the market right now because of the debt ceiling. Let's talk about what I think is the main driver of market panics, and that is the benchmark interest rate on the U.S. 10-year Treasury. Okay, and here we are looking at the U.S. 10-year Treasury going all the way back to 1965. Okay, now first of all, let's zoom in on this year here, right? Or the last couple of years. All right, up here, this peak, this is December of 2018. This is the last time the market freaked out, and that's when Jerome Powell instantly flipped from hawk to dove. Okay, he started lowering rates even though he had spent most of 2018 raising rates. He instantly lowered them, and you see rates went down, 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 all the way into the repo madness of September of 2019, and then all the way into the onset of the cerveza sickness, right? And we've been pretty much down. We've bounced a little bit around ever since, okay? So this year, we've seen rates have climbed a little bit this year, but we're still very low, 1.4%. Now, here's the deal. Here's what I want to zoom out, and this is why I don't think we're at the big crash just yet, okay? And you'll notice this purple line that I've drawn here. And that is important because, first of all, I've tuned out the noise of the early 1980s. Okay, that was Paul Volcker raising rates, ridiculously raising rates in order to fight inflation in the 1980s. Now, you could argue we're heading back there, but I don't think we ever get to that point. We'll get to why in a minute. All right, but let's tune out the 1980s for a minute, and let's look at all of these peaks since the mid 80s. All right, now if you look, starting right here where I drew the line, 1987, that is Black Monday, the stock market crash in 1987, where rates came up, boom, big stock market sell-off and panic, rates come down ever since. Moving on from there, 1994, okay, that is the bond market crash of 1994 that started in Japan, spread to the U.S. Again, rates approached that line, boom, came way back down. Going on, 1999, 2000, the dot-com bubble bursts. Again, rates come back down. The next time we approach that line, 2007, 2008, the global financial crisis. Boom, rates come back down. The next time we get anywhere near that line, December 2018, the Christmas Eve sell-off. Again, boom, rates come down into the cerveza sickness, which brings us to today. All right, all of those major stock and bond market events, all of these big black swan events, they all created a peak in this chart, and they all happen around this downward line. Now, you've heard me mention a couple of times on this channel that I think the next big sell-off comes somewhere between 2 and 3% on the U.S. 10-year, and this line is where I get that. And to be honest with you, the number 2 to 3%, that actually has a little bit of cushion built into it, because really I think it happens sooner than that. Now let's zoom in a little bit here and let's look, because we've got 2022 coming up. And honestly, where we're at right now, we've still got a lot of margin to this trend line where the market throws a fit and panics and sells off. All right, I think we've got a little bit of margin, and that's the main driver of why I don't think we're there yet. Now look, in 2022, we've got somewhere between 2.5 and 2%. All right, that is the range we have next year. If we exceed anywhere between 2.5% early in the year or 2% later in the year, I think that's when the market absolutely throws a fit. That's when the big sell-off happens. Now, here's the thing. This downward channel that we've been in for all these years, folks, we're down around zero, all right? We can't go much lower than this, all right? And with the inflation situation going on right now, with CPI at 6.2%, we have another CPI read coming up next week. Inflation is finally forcing us to confront this line, because now we're at the point where we've got 0% just below us. If we go lower than 0%, forget it. That inflation takes off and it never stops. But if we get too high above this line, the market throws a fit and we get this massive deleveraging event. And this is Jerome Powell being painted into a corner where he's got to choose between the stock market and the currency. And that's why we've been saying this for a couple of months now. He's got to pick one. He can't have both. And the fact that 0% on the 10-year is just below us, and we've got this panic ceiling and the 10-year just above us, shows that Powell is running out of time and he's running out of wiggle room. Now, there's a couple of things that are happening over the next few months they're going to force this line up. Now, I know a lot of channels like Stephen Van Meter, who, in his defense, Stephen Van Meter knows more about the bond market than I could ever hope to know. And he keeps saying rates are heading lower. I disagree, because I see a lot of the stories going on right now are going to drive rates higher. First of all, we've got Powell and we've got the market is saying there are 2 rate hikes coming next year. Okay, so that's worth 0.5% right there on the 10-year. So if we're sitting here around 1.45 right now, and we get 2 rate hikes, that instantly brings us up to 2%. So just those 2 rate hikes almost gets us to this line. Now you've got to factor in the supply and demand situation going on in the bond market. You see, again, we have all of this excess liquidity right now because we've got this huge supply of cash, but we've got a shortage of treasuries because the Treasury Department hasn't issued any new bonds pretty much for a year. All right, so the demand for the bonds is much higher than the supply, so the price of those bonds has gone way up. Higher bond prices, lower bond yields. Well, what happens when the debt ceiling gets raised? All of a sudden, you've got new supply hitting the market. Now, here's one thing I want to show you. This is the Treasury General account. Now, forget this big spike here, right? This is the cerveza sickness. We're not worried so much about that. But look back here. The average amount that's been kept in the Treasury General account has been about $300 billion in the years leading up to the cerveza sickness, all right? Now, if you zoom in on where we're at right now, we're down around $100 billion left in this account. So right away, when the debt ceiling gets raised, you're looking at a few $100 billion of new treasuries are going to hit the market instantly, okay? That is going to create more demand for cash, all right? So right away, you're going to see about $200 billion disappear from this reverse repo chart as that cash gets scooped up, as the government borrows that money out of the economy. Now, you've also got all of this recent government spending, right? The infrastructure bills, you've got next year's debt spending. So you're going to see this money is going to get borrowed up by the government very fast. You're going to get a lot of new bonds issued. Now, this is happening simultaneously as the Fed is saying they're going to reduce their bond purchases. All right. So if the Fed, the biggest buyer of the bonds, starts to reduce their purchasing, i.e. the demand for those bonds goes down, right as the supply of those bonds is going up with all of this new government spending, now we're looking at bond prices going down, 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 all right? This is going to put downward pressure on bond prices and upward pressure on yields. Now, we just talked about how just with the planned rate hikes, we've got 0.5 percentage point just from the rate hikes. Now factor in those supply and demand dynamics also pushing yields up, and we are going to get near this purple line very soon into 2022. And according to this line, again, going back on history, every time for pretty much the last 40 years that we have touched this line or gotten close to this line, the market has freaked out. And between the 0.5 point of rate hike and the supply and demand dynamics in the bond market, we are looking at enough market forces that are going to push yields right up to this line sometime over the next year. And when we touch that line, I think that is when the big sell-off happens. Now, all the forces in the market right now that are saying, J-Pow, fight inflation, right? And you've got Yellen needing to borrow more money to finance government operation. And you've got people are being pressured by inflation, creating political pressure on Powell to fight inflation. Those are all forces that are pushing these yields higher. And if we go up too fast and we get near this purple line, that's when the stock market throws a fit. That's when the sell-off happens. And the reason why, look at these debt numbers. Federal government debt, $28.5 trillion. This is actually a few days old, this data point. We just crossed $29 trillion yesterday. The last time we hit that purple line in December of 2018, that number was around $22 trillion. So we're now $7 trillion higher than the last time we hit that purple line. What about corporate debt? Here we have it, $11.2 trillion in corporate debt. The last time we hit that purple line, the corporate debt was $9.6 trillion. So we've seen a big spike in corporate debt. What about personal debt? Say mortgages. Well, look at this line. The last time we hit that purple line in December of 2018, we were at 15.4 million in all mortgage debt in the U.S. Now, 17.2 trillion. So the debt pile has gotten much, much bigger. That means the economy's tolerance for higher interest rates has gotten that much lower. And that's why this purple line is descending, because over these last 40 years, the economy's tolerance for high interest rates has come down because the mountain of debt keeps getting bigger and bigger. And that's why we have this downward slope on this line. And we are now at a point where the debt pile has gotten so big and the inflation is now so bad that we've got a choice. We can't lower rates much further. And if you look at this chart, I think we are approaching the end game of this era of easy money and low interest rates, because rates can't go any lower from here. If we go into negative rates in the US, that's it. That is the death of the dollar. It loses its reserve currency status, hyperinflation. Now, I can't tell you what choice Powell makes when we cross this purple line and that sell-off happens. I can't tell you he's going to choose the stock market or he's going to choose the dollar. I don't know which one he's going to choose, but he will have to choose. And I can tell you that that sell-off will happen before that choice gets made. That's why I've been raising cash, and that's why I think that sell-off is coming, but it's also why I don't think we're there yet. I think we have enough margin between where we're currently at and this purple line where it's a few more months away at least. But with the planned rate hikes, with the planned taper, and with the raising of the debt ceiling and the ensuing government borrowing, I think we are going to very rapidly rise to hit this purple line. So long story short, with everything I just described in the bond market, I just don't think we're there yet. I think we still have a little bit of wiggle room before we reach that panic level in the bond markets when this mountain of debt causes everybody to freak out and we cause a liquidity crunch. I think there's still enough liquidity sitting in those reverse repos to gobble up at least the first few $100 billion of these new bonds that are coming out. But I think once that taper takes effect and once the new borrowing takes effect and then Powell starts hiking rates later next year, I think we very rapidly get near that purple line, and that's when all hell breaks loose in the economy. So what do you guys think? Am I wrong? Is this the big one? Are we already there? I mean, we've got a big CPI read coming up next week. That could cause a panic in the market. We've certainly got this China Evergrande situation going on. That could cause panic in the market. So let me know in the comments. Do you think this is the big one? Or am I right? Is it going to take a few more months? Or am I just completely wrong and onward and upward to new highs forever and ever? Let me know in the comments. Guys, I want to thank you for your time. Thank you for watching this video. Don't forget, give me a thumbs up, subscribe to my channel, hit that notification bell. It really helps me out, and I'd be forever in your debt. Until next time, live small and dream big.